Good day. This is Richard Wexler with Caring in America, the podcast for caregivers and care recipients. Folks, who've been listening to me for a long time know my story. 20 years ago, minding my own business in the software industry, married later, two small kids. All of a sudden, the phone starts ringing, and we're caring for all four of our parents. That care lasted 14 years until the last parent passed away at 96 in 2019. Doing a lot of education across the country, going back to '05. Once that started that adventure for me. And then earlier this year in January, we launched our national foundation, a nonprofit, a plan to age, really trying to help people understand why it's so important to plan before a serious health event, a fall, diagnosis, combination thereof. We have a special guest today. I'm going to work through his bio and introduce him. Mark Maiman has closed in excess of 2 billion in total loan volume since entering the mortgage industry in 2002 and has been ranked among the top loan originators in the nation every year since 2006. He has been recognized as a power originator and a Hot 100 mortgage professional by Mortgage Professional America magazine and regularly contributes to national publications, podcasts, and training for top real estate firms and financial organizations. Mark's bi-coastal team has a client roster that includes award-winning entertainers, professional athletes, high net worth individuals, real estate investors, seniors, and their families navigating the rising cost of care, and first-time buyers and everything in between. He runs the successful National Bridge Loan Program that services approximately 30,000 professionals across the country. His platform rapidly expanded into the senior space to help seniors secure financing to help pay for entry fees, home repairs and renovations, ongoing care expenses, and other living expenses. Mark, are you there, sir?
I am, yes. Thank you for the introduction. I couldn't have written it better myself.
You're very welcome. Where are you actually sitting today?
Today I'm in Los Angeles. I'm bi-coastal between New York and LA.
What's the weather like in LA?
Oh, it's as usual, it's sunny.
Outside of Boise, Idaho, where I am, we are baking. It's been this past weekend and also today about 100 lovely degrees, so
Wow.
a little bit warm. So I want to start by asking you some questions. What are the common threads and challenges you see seniors facing these days?
Sure. Well, I would say seniors have a lot of equity in their homes. Many of them have been in their homes for decades. It's what I refer to as a buy and hold generation and a do it yourself generation. I don't think this generation that's aging now grew up in the same environment like we're in now, where young professionals have financial advisors and they have estate planning attorneys and they have this whole, hopefully if they're doing things the right way, they have this whole financial team supporting them in all different aspects. And I don't think the generation that's aging now had that as they were coming up in their professional lives. So a lot of them are used to doing things on their own and maybe using some rationale that worked well in the past, but may not be in their best interest long term. But the biggest common thread is that they're oftentimes waiting to make a financial decision, whether it be to sell their home, keep their home, finance their home, move into assisted living or memory care or whatever it may be until there's a crisis moment where they're almost forced to do something. And the hope is that people, and the reason we join this podcast and we run our own as well, is to raise awareness about how important it is to plan ahead. And that's why obviously you and I clicked as well as we do, because we're both big proponents of that. And we see so many people not doing that and acting in a moment of crisis where the options are far less. Um, so it's an opportune time to be working with seniors and just the number of people that we can help, because obviously the aging population is growing, and also because people have owned their homes for so long, there's typically a lot of equity in their homes that can be used to help pay for care. And I think oftentimes people don't realize that, or they don't know how to do it. And that's where we can come in and be helpful as one of hopefully many people involved in your financial team.
Some awesome advice, folks. And as I say to you all the time, please share this information. What Mark's talking about is fantastic information. Let's talk about mortgages, and are there any common misconceptions about seniors' ability to qualify for that mortgage?
Yes, there's one main one, and it's very prevalent, is that um, people won't qualify for anything other than a reverse mortgage. And reverse mortgages, whether you love them or don't, there are some benefits and downsides to them. But one of the main reasons why seniors utilize them as much as they do is because the qualifications are easier. They're not driven by your wages, your income.
Sure.
But there are other alternatives out there that I'm sure we'll get into in a bit more detail. But that's the biggest misconception, is that that's the only option for people to consider when they're looking at using their home as potential leverage for paying for care, or moving into a care community, or whatever it is that their need is at any given time.
No, and again, that's great advice. What would seniors want to consider when thinking about using their equity in their home if they have to pay for care, whether it is in a community assisted living, memory care, or care in the home? What should they
Sure.
be thinking about?
Well, there's different considerations if you need money short term versus long term. So if you need short term funding, let's say it's to move into a community, and you need the initial handful of months of payments for the rent, and maybe some moving expenses, maybe some money to repair your current home to get it in the shape that it needs to be in to be quote unquote show ready for a real estate agent to come in and really be able to get you top dollar. There's different considerations for that type of loan, where you might want to be looking at, if you have investment accounts that is the other alternative, let's just say to use that to find those funds. What you want to be mindful of, and this is where the financial advisor comes into being an important part of the planning of these different steps. But you want to be mindful of what the tax implications are of liquidating investments or a retirement account to pay for those things, because the last thing you want to do is create a taxable event for a short-term need. And oftentimes the bridge loan can be far less expensive than the tax implications of pulling out the capital from other investments, especially if you've owned those investments for a long period of time. If you're looking at longer term care needs, then it's similar. You want to look at how, then it really comes down to how long is your money going to last, and is it going to last long enough based on how much you have and what your cost of care may be for the type of care that you're looking for, and what are the strategies that you can use to make it last longer, so that not only do you have the care that you need for as long as you need it, but that you also have a legacy to leave behind, because that's also a common thread. That's a very important factor for
Yep.
seniors is, oh, I promised my grandkids I would leave them the house, or my son lives with me now, and I need to have a place for him to live. And so there's a lot of considerations when you're working with seniors and their families on legacy planning and the emotions around real estate, which are not to be underestimated. They're strong. So there's different considerations depending on if you're looking at long term versus short term. But capital gains tax is also a big factor if you are going to sell your home. A lot of seniors are not aware of something called a step up in basis, where you might be able to completely avoid or at least significantly diminish your capital gains tax if you sell after the senior passes versus before. So it's just a matter of getting your ducks in a row. This is where all the proper financial advisors, tax advisors, estate attorneys, when you have all these people involved, you can come to a proper conclusion together as opposed to looking at one piece of advice that may have one perspective and not the others.
No, again, this is fantastic advice, and obviously, we're in an organization called Plan to Age, but we're talking about planning and really trying to get folks of this generation, as you said a few minutes ago, really to understand getting ahead of this with the tax implications, the family and emotional implications of leaving the house to junior or the daughter, or leaving a good pot of money or whatever the case may be, and understanding of what you said when we first started the podcast, that the generation today, their kids may be working with the estate planner, the financial planner, all the appropriate people, but moms and dads that may be 65, 70, 80 and above haven't done that. But as you're pointing out, there's so much that should go into this from a thought perspective. I've actually had some great guests on the podcast talking about reverse mortgages. There is some thought out there. They may not be the greatest. There's also some thought out there that they're very good for a lot of people. What's your take
On different products, you mean?
on the reverse mortgage?
Reverse mortgage in particular. Well, again, a lot of people think there's no other alternative, but there is. I have a few issues with reverse mortgages, but sometimes they are the right fit. Why don't we start with when I think they're the right fit first? Because the list of why I don't think it's the right fit is a little bit longer. Um, where I think they're a really good fit is when you have memory care issues where a senior cannot, um, doesn't have the mental capacity to sign loan documents on their own. So obviously, a lender doesn't want a situation where someone is falling for a scam of equity theft, where someone else has authorization to sign on behalf of the senior who maybe doesn't have mental capacity to sign on their own, and then they actually steal that equity or that loan, the loan proceeds, and use it for their own benefit rather than for the benefit of the seniors. So reverse mortgages are more friendly to that type of arrangement because it's a common issue where they allow for people signing by power of attorney more so than a traditional or alternative program might. So that's where I think reverse mortgages can be really helpful when you have that type of issue. My main issues with reverse mortgages are, the first one is that you have a compounding loss of equity, and I'll explain what I mean by that. So the best thing about a reverse mortgage is that you don't have to make a monthly payment out of pocket. And the worst thing about a reverse mortgage is that you don't have to make a monthly payment out of pocket. It's exactly the same. It's good and bad. It's good because you don't physically have to have the capital available to write the check or make the deposit every month to pay the mortgage. But what happens is when you don't pay the mortgage, let's say you're 3 years into that reverse mortgage, you're now paying interest on payments that you didn't make 3 years ago, and the month after that, and the month after that, and the month after that. So you're paying interest on interest on interest. And so what happens is the longer you're in a reverse mortgage, the faster you're losing equity because it's compounding against you. It's the opposite of compounding in an investment account where you might have, investments of stocks or bonds or whatever it might be. That's compounding in your favor. When you're not making mortgage payments and you're accruing interest on interest, it's compounding against you. The other things are the flexibility. If your care needs change and you need the flexibility potentially to move into assisted living or memory care, if staying at home has just gotten either too expensive or just that your care needs have changed to the point where it's just not feasible anymore, One of the issues with the reverse mortgage is that there's an owner occupancy requirement throughout the duration of the loan. So if you need to move into assisted living, you have roughly 6 months to pay off that loan. And what happens is sometimes, most times people wouldn't take a reverse mortgage if they were able to pay for the care out of pocket. So what's happening is now they don't have a means to pay off that loan in any way other than selling the home, which then triggers the capital gains tax before the senior passes away. So that's why it can create a situation where you don't have any option but to pay the capital gains tax by selling the home because you're required to stay in the property. The other things I would say are just that the interest rates are surprisingly high. The closing costs can be very high. And the amount of equity that a reverse mortgage allows you to tap into usually doesn't exceed at most 60%, and many are even less than that. So you can't get access to a lot of the equity in a home, especially if you already have a mortgage on the property. There may not be much more to pull on from a reverse mortgage if you're looking to pay for the cost of care. So there are other alternatives that I think may solve those challenges a little bit better in some circumstances.
Yeah, let's talk about that. What alternatives are out there that seniors and their families should know about? I mean, I talk all the time. One of the biggest expenses most of us are going to have at some point is the cost of care. What other
Yes.
alternatives are out there?
Yeah, and to add to what you just said, most people have no idea what the cost of care is until they're faced with it,
Correct.
because they don't plan ahead or they're just not aware. I was in a presentation just earlier this week with a bunch of financial professionals who also were shocked at what the current cost of care is. They're not aware, even though they're probably serving some seniors or people that will be seniors at some point, in their near future. But some of the alternatives, there's different products available for different situations, but the common thread through all of them is that they can't be effective if they're going to be driven by income. And conventional underwriting is almost not exclusively, but primarily driven by income. So if I was looking to buy a home, the first question out of a lender's mouth, which of course I'd be my own lender, so it's my own mouth, what is your income? So that's the biggest factor for conventional lending. So if you're lending to seniors who are on a fixed income, maybe Social Security, maybe pension, if they're lucky enough to have worked for a company that offered them, that didn't pull them out from, pull the rug out at some point over the last 20 years, it's still not going to be enough to borrow potentially the hundreds of thousands of dollars that you might need to pay for care over the course of several years. So the products have to be driven by other factors. They can't be approved strictly based on income. So we have some products where, for example, that this may not have been designed with seniors in mind. In my opinion, it was probably designed for entrepreneurs who just started a business or maybe recently went self-employed after being employed by a company where they might have difficulty qualifying. But there are programs that don't require a statement of employment or income, and there's no age cap on that. So that the application of that product can apply to a senior. Interest rates are also better than a reverse mortgage on those, even though there's no real major documentation that's being looked at. Then there are other products where, for example, if you have some money set aside in an IRA, you can convert those assets into additional income on the loan application without doing anything with the money. You're not using it as collateral for the loan or anything like that. It's just another way to be able to generate more income to help you qualify for a larger loan. And that's usually the biggest challenge that we work with clients trying to figure out is how much of a loan can we potentially get them and all these different ways that we could do it. What's the best outcome as far as the terms and the amount that they want? Can we get that amount maybe on this program, but not on that program? So there's a lot of different products that we use to try to connect the dots to make sure that the senior is getting the right type of financing. I'll give one example. If we had a recent client come to us trying to get just a standard line of credit, had been denied for the same type of loan from three other sources. thought that reverse mortgage that was on the table being offered to her was the only option. And the financial advisor said, please call Mark's team and let's figure this out to see if that is the only option. She did have some IRA money. We converted that into additional income, got her a line of credit. A line of credit made more sense for her because she was preparing in advance. This was not an immediate cash need. This was I want to have access to some of the equity in my home because that's my biggest asset, but I don't need it yet. And a line of credit is great because you don't have to pay interest until you actually borrow the money. So if you don't need a big lump sum of cash for, if you're moving into a CCRC community where you might have an entry fee, for example, that line of credit could be really appealing as a great financial tool. So in that case, that was the right fit. The little niche that we had as far as converting the assets into income was what she needed to overcome the other three declinations that she had, and we were able to get that loan for her, and have her avoid needing to do the reverse mortgage, which would have required her to convert her 3% mortgage into 9.5%, which she was not thrilled about doing. So that's just one example, but there's a lot of these products that you can get really creative with, if you have the right advisor that has access to the right programs that support the needs of seniors.
Again, folks, this is great information. I really encourage you to spread this information, friends, neighbors, family, co-workers. I mean, as we've talked about, I say this horrible four-letter word over and over again called plan. And what Mark's talking about too, the sooner we think about all this, get ahead of all this, the easier the process. His comment a few minutes ago, most people don't know what care costs. They're shocked when someone like him, myself, informs them what they're looking at to bring someone in the home, what they're looking at for an assisted living, talking about the entry fee to a CCRC, what it costs to go to a memory care community. And which is also sad that Mark brought up, and I've been yelling about this for years, we have to get the financial industry to really understand what are the options for care. I just talked in the last minute about 4 or 5 of them, and also understand what those options cost so they're counseling their clients the appropriate way, they're saving with the appropriate vehicles. Because unfortunately, the number that I use, probably 95% of us or more are going to need some form of care, whether it's an hour, many years, or something in between. All these different products you're talking about, Mark, is there a way to help seniors avoid paying unnecessary capital gains taxes?
Well, yes. So this is where the tax planning comes in. So in two ways, the answer is yes. One is, and this is the analysis that you were hopefully doing with a financial advisor. When we have the full financial team, we know we're approaching it in the right way. And sometimes the outcome is that we don't do any loan at all, and that's fine. Um, but the ways that you can avoid capital gains tax are for the short-term financing, avoiding the liquidation of assets, pulling money out of an IRA. You're gonna get a tax bill from that, even if you only use the money for a relatively short period of time. And that's where the financial advisor and the tax advisor can come in. But where I think people underestimate it the most is the capital gains tax on selling their home. So, for the audience that may not be familiar with this, there's something called a step up in basis. And in full disclosure, I'm not a CPA, so please have this discussion with your accountant to make sure that you know how this applies to you. But the general rule is that if you sell the home while you're still alive, you're going to pay capital gains tax based on the basis, which is what you acquired the property for, compared to the price that you sell it for. And so if you're of the current generation and you fit the mold that you've owned the home for 40, 50 years, no matter where you are in this country, you bought it for a lot less than what you would sell it for. And in higher price markets, it could be millions of dollars more. And we've come across situations like this before. And in the event that you hold on to the property and let's say use financing to be able to pay for care rather than selling the home, what you might be doing is what you're trying to do really is buy time and not sell the home from a tax planning perspective until after the senior passes away. And the reason you do that is because this step up in basis that I referred to, what it means is that instead of the IRS comparing your original acquisition price as the basis of what they compare the sale price to, the basis or gets stepped up to the value on the date of death. So if you pass away and then a month later your family sells the home, you could have zero in capital gains tax, depending on the numbers. That's where the accountant comes in and the advisors come in. As opposed to selling it right before you pass, you could have hundreds of thousands of dollars. We came across a case recently in Southern California, high end market that was not so high end 50 years ago, where somebody had bought a property for $20,000, sold it. A 97-year-old woman sold it for 4.5 million, and she wrote, probably not knowing any better, that there was an alternative. Because unfortunately we heard about this after it had happened, but she wrote over $1 million check for taxes. And so instead of that money potentially going to family, if they had taken a loan in order to pay for the care, and she was 97, so knock on wood, hopefully she had lots of great years left, but she was approaching 100, so maybe not. But if she had taken a loan out to pay for care instead of selling the home, that $1 million would have been in the family's hands rather than the IRS's hands. And so I think people grossly underestimate, especially with the current generation where they've owned their homes for many years and built up a lot of appreciation. A lot of people underestimate how impactful that capital gains tax is. And because they don't have the right advisors, they don't know the best way to avoid it or the best timing to sell the home. And sometimes you'll have seniors whose sole advisor may be a real estate agent, and they say, well, I need money to pay for care. I'm going to sell my home. I'm going to call the agent, and maybe the agent isn't aware of the step up in basis, if they're not engaged with seniors very often or haven't educated themselves on that or just haven't come across it. Nothing against them. They're doing what they're hired to do. They sell the home unknowingly, subjecting the family to a significant amount of capital gains tax that could have been avoided. So that's how loans can be helpful in tax planning. And that's where the financial advisors come in play. The estate attorneys, the CPAs can help you figure out how much of a capital gains tax you might be subject to if you sell the home before you pass versus after.
Again, I keep on saying, wow, folks. I mean, this is great information. As we get ready to wrap up, I talk about three little words that are 4 letters long. Talk about care, we talk about cost, and we talk about a word that we've said a few times on this podcast edition today. That's plan. So, what advice do you want to leave people with as far as planning? And this generation that we're talking about that may not be working with all the professionals like maybe their younger kids are, what should they be thinking about from a planning perspective, Mark?
Well, you definitely want to figure out what the capital gains tax calculation would be. That's not a difficult thing to determine, but very impactful. But a lot of times people don't use those professionals because they don't want to pay for them. They end up paying 100 times more in
Sure.
problems and taxes
Yeah.
than it costs to actually engage with them. But there are a lot of resources as well, nonprofits and whatnot. And, Plan to Age is a great resource that I've become familiar with, fortunately, through you. And so there are resources out there for people, but you want to talk to as many professionals as you can about the implications as it relates to their profession, because that's the one that they're going to know the best. So if you don't have the financial team, my first advice is get the financial team, start to engage with those people, even just ask somebody who is in the industry, are there any implications, things I should be thinking about? These podcasts are great. We have a podcast as well that has a lot of great information. Where we've interviewed amazing people that talk about all the different aspects of this. Um, but the key is to not wait until there's a crisis moment because your options diminish substantially when that's happening. Now all of a sudden you need money quick. Sometimes quick is not inexpensive. And sometimes you need more money because you need an immediate need and you're not really sure how to plan for it. So you end up having to borrow more than you think you might need because you're just not sure because you haven't planned. You don't know what the cost of care is. What about if things change and you need more? How do you do that? So, and the different types of products, some of them may close faster than others. So you diminish your options if you don't plan ahead. But that's my biggest advice is don't wait for the crisis, number one. And by not waiting for the crisis, what I'm telling people to do is talk to the experts who can help them figure out all of these different strategies and implications for different choices that you might make along the way that could have significant implications.
Again, great advice, folks. So, as we do get ready to wrap up, Mark, please give out some contact information, whatever you want to give out, email, website, the name of your podcast, etc., phone number.
Absolutely. So the best way to find us and get all of that information, we have two websites. We have one for seniors and their families, which is seniorfinancingsolutions.com. Again, seniorfinancingsolutions.com. That's for seniors and their families. For other professionals who are looking to find ways to support seniors and their families, or potentially who already engage with that audience and want to get an education through our podcast and YouTube channel. The website for professionals is financingforseniors.com. And so there's different ways to connect with people through that. We have a great network of people, as I'm sure you do. So anybody who needs a referral to a different type of professional, more than happy to do that. But that's the best way to find us.
That's awesome. This has been a great episode, and I want to thank you, Mark, for all the wisdom you've given these folks in the last half hour or so. And again, folks, until we talk again, have yourself an awesome day.